Right, there we go. Everyone should be able to hear me now. That should now work. Okay, just let me know in the comments if you can hear me. No sound you're saying there. You should hear me now. So I'm going to start again. There's a big surprise in the news coming out of the Bank of England that there are going to be no interest rate rises. So this was not what we were expecting today. If you joined my live last week, we talked about the mortgage rates going up with some of the providers. So Barclays, HSBC were a few of the banks that increased their mortgage rates in anticipation that the Bank of England base rate would go up today. And literally this afternoon, there's been a vote 7-2 to keep interest rates the same. So what I want to do in here is maybe just talk a little bit about what that essentially means. This is completely unexpected. The Bank of England and Andrew Bailey have been signposting that because inflation was in the budget estimated to run at 4% next year, that they would have to intervene with an interest rate rise to try and counter that inflation. And they haven't moved. And more interestingly, they have upgraded the expectation for inflation through to next year, up until April next year, up from 4% to 5%. So that's a really big jump in the forecast and the expectation of inflation moving forward. And I thought, look, we'll talk about this specifically because I wasn't expecting this. And it's going to be really interesting as a conversation. Let's start off, though. Let's talk about how the Monetary Policy Committee actually works in the Bank of England. So essentially, on the Monetary Policy Committee, we call it the MPC, there are 9 people essentially on there. And in order for there to be either a rate rise or for things to remain the same, you need to have 5 out of the 9 voting in favor of a motion. So what they would have done today is they would have sat down and they would have had a look at the situation. They would have voted around, right, should we increase the bank rate? Now, again, it was forecasted that they were going to increase the bank rate by 0.15%, which would take it to 0.25% overall. So what they've done is they've voted, and 7-2, they've decided to keep it the same. Now, if many of you follow some of the financial news, you've probably noticed some news coming out this morning that the Fed in the US also decided to just keep rates low at this point in time. What's really interesting was that the Bank of England was always going to be the first global central bank to move on interest rates if they decided to do that today. And so that isn't really it was expected that they would be the first. But what it feels like, though, is they've kind of second-guessed themselves. And it's interesting reading some of the commentary and some of the rationale behind this. I think there is still this view that this rate of inflation that we're experiencing right now is still transitory of nature, meaning they expect it to subside and get back to normal levels over the course of time. And this transitory phrase, this transitory conversation, I had Gary Stevenson on the channel on Sunday, and we spoke about interest rates towards the end of the stream. And he spoke about the fact that with interest rates, the whole conversation around transitory has been mismanaged in his opinion, because he felt as though the central banks have tried to pedal back off it because it has taken longer for the economy and for the bottlenecks in the supply chain to ease. And as that persists and we start to see the cost of living, the cost of energy prices, for example, increasing, then essentially it no longer becomes transitory if it's not going to dissipate over a period of time. But reading some of the commentary, and I might actually just share my screen with you on here so you can actually see some of the commentary that we're talking about here. First, actually, let's talk about some of the social media reactions from this, because I think everyone is kind of like myself. We expected that it was going to go up today, and it would have been an opportunity for them to intervene with some policies that would have counteracted that pinch that we're all feeling right now. But it feels as though they're kind of stepping off at this point in time. So this is just a couple of tweets here. More misleading signals from the MPC. These days, they always delay or duck the challenge of raising rates. It's a shambles, so-called independent central bank. Again, I think the sentiment here is the fact that they've been signposting this for a while now, saying that they were going to have to move. There's more in here as well. The MCB decision was no surprise to me, consistent with the pattern of ducking difficult decisions over the past decade. What's the point of an independent central bank if it's so timid and toothless? Again, from the same guy on here, it's really, really interesting to see this because, like I said, this was supposed to be the expected move. We were expecting the interest rates to move. The bigger question is this. This is good news. Let's start with the good news first. This is good news if you have a mortgage. So if you are on a standard variable rate or if you're on a tracker rate, this is good news for you because as long as you're not with any of the banks that have already increased their rates, then there is no threat of your mortgage payments increasing in the immediate term. And when I say the immediate term, we don't quite know the timeline towards the next increase. I mean, they meet quarterly at the MPC, at the Bank of England. So potentially we might see a change. Where are we right now? We're in November. So we might see a change come February, maybe March next year. But for the time being, you're not going to see an increase in your mortgage rates, which is a good thing. That is absolutely good news. If you're with the likes of Barclays, Halifax, or HSBC, I believe were the three, and I think Santander also joined the ranks of them, who essentially increased the mortgage rates or at least pulled some products out of the market in anticipation of this. The question is, will they backtrack? Probably not. So if you have a mortgage, you don't have to worry in the immediate term. I think what the commentary is providing, though, is that we are likely going to see a rate, the rate increase, I would imagine in the first quarter, maybe second quarter of next year. And this is a really important point. Oftentimes with these kind of monetary policies, the Bank of England will signpost what they are intending to do. So when you read that they are anticipating or forecasting or projecting that rate increases may occur within a set period of time, what they're essentially doing is they are signposting that so that essentially you're able to prepare yourself. So the question is, if you do have a mortgage right now, there are probably a couple of key things to essentially consider. So there's not going to be any immediate interest rate increases right now for you specifically. But with the knowledge that potentially we might see interest rates increase maybe Q1, Q2 in 2022, is it prudent perhaps to look at fixed rate mortgages right now whilst the rates are still low? Because make no mistake, if the bank rate had gone from 0.1% today to 0.25% today, then you could probably put your bottom dollar bet on the fact that other banks would then actually all of them would increase their mortgage rates. So there's a little bit of good news here, and maybe some homework for you to do if you do have a mortgage and you're not on a fixed rate at this point in time. And we can talk about the fixed rates in a moment. The first one is maybe consider having a chat about getting into a fixed rate mortgage anyway. Now, there are often a common question that comes up when we speak about this, and it came up on Sunday when we spoke about the interest rates or the potential increase to these rates today that hasn't happened today. The question is, well, do you go for a 2-year fixed rate or maybe a longer term fixed rate? So maybe like a 5-year fixed rate, if that is an option to you. Now, I've got a couple of views on this. I think if you go for a 2-year fixed rate, what you essentially do is you'll probably lock yourself into a better rate, so a lower rate. And the reason for that is because as a mortgage company, you know that in 2 years' time, you're going to be renegotiating that rate at that point. Now, it's a 50-50 kind of equation here because in 2 years' time, the rates might increase. So because you've locked yourself in for two years, yes, you're going to get the benefit of a fixed rate, your mortgage payments being fixed over that 2-year period, but you might get round to restructuring or remortgaging your rate in 2 years' time and find that the rates have actually gone up. So it's a risk. It's 50-50. You have to decide whether that is the best scenario for you. From a practical point of view, and I said this last week when we talked about the possibility of the Bank of England increasing the rates today, which they haven't. I spoke about getting back to basics, looking at your finances to make sure that if you did see an increase, for example, of £80 on your mortgage payment, you weren't going to be overstretched. Those fundamentals still basically apply here, particularly if you're trying to decide between going for a 2-year fixed rate or a 5-year fixed rate. Now, with a 5-year fixed rate mortgage, it's important to understand that essentially, because you're fixing in for a longer term, so longer than 2 years, the rate that you're going to be offered right now for a 5-year fixed rate mortgage will be higher than the 2-year rate. The reason for that is for all the reasons I just mentioned. In 5 years' time, you may have higher rates, but you haven't been in the position where you remortgage or renegotiate or rebroker that rate in 2 years' time for the banks are potentially to benefit from better rates. With a 5-year mortgage, because you're getting a higher rate, what that basically means is that when you compare the mortgage cost month from month, the 5-year fixed rate will cost more than the 2-year fixed rate. But the key question to ask yourself here is, do you want peace of mind? If you want peace of mind, which I'm sure you will do if you look at a fixed rate mortgage, then the question is, how long do you want that peace of mind, that stability for? Do you want it for 2 years or you don't want it for 5 years? That is a question that only you can answer. And again, doing simple budgeting, trying to have a look at what your household finances are, will give you the answer to that question. If you want the security for the long term, then you may want to be looking at a 5-year fixed rate mortgage. If you want it for a relatively short period of time, say 2 years, then you would go for the 2-year fixed rate mortgage. And that really does lead us on to the next point, which is one that Gary mentioned on Sunday. So Gary, if you've not watched the live from last Sunday, by the way, worthwhile going to have a look at that. We spoke about the budget, and we broke that down in terms of what that basically means. But towards the end of the stream, we spoke specifically about interest rates. Now, Gary was a interest rate trader. So his view was that if you don't mind having that short-term security around what your mortgage payments are going to be, his opinion is that you should go for a 2-year fixed, because looking at the long term, he didn't feel as though interest rates would move significantly to the point. Now, you could debate that. That will be dependent and determined by a number of different factors. So continued inflation, employment rates. It will have a lot of factors involved in that. But his view was go for a 2-year fixed. Again, you have to consider what is going to be best for you. If you want the security long term, so for longer than 2 years, then maybe a 5-year fixed rate mortgage will be better for you. If you don't mind taking the gamble of in 2 years' time, you fix yourself in, but you may encounter higher rates. So you might take a bit of a step up to your mortgage payments in 2 years' time, then 2 years might be good for you as well. So just some tips in terms of what to look out for. But I think because they have kind of held their nerve at the Bank of England, I think it will be prudent if you do have a mortgage to maybe at least have those conversations right now. For many people here in the UK, a mortgage is their highest and most expensive monthly outgoing. So if you're able to streamline, make that more secure, then from a financial point of view, in terms of planning, you should be in a better place. But as always, horses for courses. There is a question around whether, what does this do for savers, I guess, is the question. Not a lot. It just means that essentially we continue to have low rates, and there is no, sight of those rates increasing anytime soon. There is the conversation of, in this world where you have the rate of inflation being so high. And again, this is why it's such a surprise. We talk about money, making your money work hard for you. Inflation is a key component of that. If you've got money in cash right now in a bank account getting, 0.2% if you're lucky. If the rate of inflation does indeed rise to 5%, then essentially the money that you have held in cash is going to be eroding in value. So essentially, you're losing money by having money in the bank. Now, that isn't a great thing for savers. And even though an increase in interest rates today to 0.25 wouldn't have really made that much of a dent, it would have helped just a little bit from a saver's point of view. And I think this conversation is really important around inflation and interest rates, purely because if you look back over the stock market over the last certainly 18 months through COVID, we've seen an increase in asset prices. We've seen a surge towards the markets because that seems to be the place where you are able to make your money work harder for you and you're able to beat inflation. I mean, it's easier to beat inflation at the target rate that the Bank of England sets at 2% than it is at the current rate of 3.1% and what they are projecting it's going to be at 5%. It essentially means that now, if you are investing, potentially you need to be looking at investment strategies. If it persists at 5%, that is going to give you a return of 5%. And this is where we can start talking about the charges that you're paying for your investment vehicle as well, because your return should be net of fees. So if you are in an investment proposition, potentially where you're paying, 1%, 1.5% in fees, but then all of a sudden the amount that you need to achieve as an investment return, inclusive of your investment charges, needs to be significant. So it's a really interesting. I'm back. So it's just a really interesting place to be right now, and it will be interesting to see what happens with the markets over the coming weeks with regards to this, because it's this was not expected today, and I'm very, very surprised that they've not bitten the bullet, particularly with an upgrade to the inflation numbers going up to 5%. I'm very, very, very surprised at that. I've got news going at the moment, so I'm getting all kinds of alerts at this point in time in this topic, because this is very much a surprise. It really, really is. I'm just going to see if we can actually see any commentary from Andrew Bailey in terms of what their decision was here. I actually do want to show you this, because these numbers are kind of paint the picture as to where we are. Bank of England leaves interest rates on hold at 0.1%. Big surprise for investors, many of whom had assumed there would be hike rates. It talks about the vote ratio here, so 7-2 to hold. QE carries on as planned. This is an interesting point, because the Americans yesterday, they are tapering back on their QE, so then they're going to be tapering back on their initiative to keep asset prices where they were, as that lifeline to keep asset prices and sustain the markets. We're continuing with that, so that's interesting. But this is the big one. Inflation now forecast to touch 5% next year. I mean, that is incredible, really, to be fair. It's a really, really big increase. And I think while we're looking at energy prices, this is where families are going to feel the pinch potentially, which goes back to, the things that I alluded to last week. This is going to be about, going back to basics and really trying to ensure that, from a financial point of view, you kind of know what you've got coming in and what you've got going out, and trying to clearly separate the needs that you have and the wants that you have, and be really honest and look at it dispassionately and try as best as you essentially can to ensure that you know what your financial situation is. The irony behind all of this is the consequence that inflation being that high has on everyday life. I was having a conversation with someone yesterday, and we were talking about the rise of COLLAB, for example, buy now, pay later, and how easy it is these days to get into those kind of schemes. The reality is that if you're just a normal family, a normal household, and you're finding that the cost of things are increasing around you, and you're in a position where you can't quite make those financial cuts and tighten your belt tight enough in order to be able to cope and survive, particularly with the universal credit cuts, and we've got NI tax increases next year. If you're looking at your finances and those things are a real struggle, things like Kalana become really, really attractive and very, very easy to fall into. And we can talk about the impact of those kind of services and what it could potentially, the damage that it could potentially cause, really. And I think that this is where the expectation was, by increasing the Bank of England base rate slightly, would counteract that inflationary impact that we're going to find. And this is why you're hearing the disdain in a lot of the tweets around the Bank of England being toothless and, lack of confidence, so on and so forth, because this was a much needed measure in the context to the forecast. I mean, at 4% inflation, that's pretty high. That's really, really high. With it being upgraded to 5%, people are going to feel this day to day. People are really going to feel this day to day. And one thing I'll just say in maybe closing this session down is, it's really, really important. Don't be afraid to ask for help where you can. There is no shame in admitting that you might need a little bit of help. If anything, I believe that that's probably a point of strength. Knowing that you actually need help and asking for help is one thing. But where you can, and I know that it's difficult, I know that it's easier said than done, but where you can, please avoid using things like Kalana and credit where you can. I know that in some cases it is unavoidable and it will feel like that, but please try to avoid it. And if you do use those facilities, just bear in mind that these things do need to be paid back. So again, I talk about budgeting a lot, and I feel like a broken record, but those foundations are really, 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 really key. If you can make cuts in your expenses to start off with, yes, they might be painful, particularly if you have family, and the things that you might consider cutting will be, TV channels for the kids. Yes, that will be painful. I absolutely acknowledge that. But it will be easier to make those cuts first than using things like Kalana, overdraft, credit cards, so on and so forth. And just bear in mind that if you are going to be making these cuts, they are not going to be forever. Hopefully, we do get back to an environment where, inflation is proven to be transitory, hopefully. And, everything does come back to the levels, like 2%, around about there, what we're used to. Once all the bottlenecks start to lift, supply chains started to get back to normal. Hopefully, that is what we get to see. But for the time being, it just means that we've really got to look at it practically, pragmatically, and think about it from a household point of view. What can we do? What are the things that are within our control that we can change, that we can tweak, that will get us in the best position possible? The Bank of England and the monetary policy there are things outside of our control, completely and utterly. In order to really make a difference, in order to really have an impact that we feel we can control, it's those internal things. It's budgeting, the needs and the wants, making cuts where you can. And I apologize if that sounds really, really boring to anybody watching this, either live. I know there are a good number of you watching this live right now, or anybody watching this on repeat, but I cannot stress this enough. And it may take another 15, 20 minutes out of your day, but it will be an exercise that is worthwhile having, because, people will start to feel the pinch as we head into this, and as this rate starts to come more apparent in the everyday spending that we're seeing. So take 10 to 15 minutes, 20 minutes, half an hour if you need to. It's an A4 sheet of paper, put a line down the middle, your income, your expenses, and just go at it. Be dispassionate, be truthful with yourself, be honest, see what you can actually cut. If you're on a mortgage, I'm just going to recap for that. Yes, the rates have not increased today, surprisingly. However, because the rates haven't increased, you will not see, or you shouldn't see, I would say, fingers crossed, hopefully, the banks don't feel differently. You shouldn't see an increase in mortgage rates, aside from the banks that have already increased their mortgage rates last week in anticipation that the Bank of England would increase their rates. So it might be worthwhile actually speaking to your bank, a mortgage broker of some kind, to see what fixed rates you might be able to lock yourself into. There is likely going to be increases maybe Q1, Q2, 2022. Their forecasting is it will probably go up to maybe about 0.5%. I believe that is in the first quarter or so of next year. Well, certainly the first half of next year, going up to 0.5%. If that does happen, then you will see a bounce in mortgage rates at that point, almost certainly. So to be prudent, and again, within that budgeting to try and streamline your finances, if you're not on a fixed rate, it may be worthwhile actually going out right now to see what deals there are on fixed rates, choosing between either a 2-year, 5-year, or maybe even longer. But again, think about some of the considerations that I spoke about earlier in the stream around what is going to be most comfortable for you as a household, and from a monetary point of view when you're planning your household or your personal finances. Those are really important key points. Unfortunately for savers, nothing changes. And really that is it's painful because inflation erodes your cash. So emergency funds immediately come to mind. So alternatives for emergency funds, can you go NS&I premium bonds, potentially for a part of your emergency fund or a portion of your emergency fund? There is no risk there. It's tax-free. Potentially, maybe we need to be a little bit more creative. But I think what the sentiment that most people will be left with is, how do we make our money work harder? That is the question that is always forever being asked. And it's an important question. I do understand that. But this is a bit of a shock bit of news today. I didn't think we were going to be having this kind of conversation. I was fully prepared for the Bank of England inquiries to actually come along, and we'll be talking about interest rate, the Bank of England rate being 2.5% today, and then possibly looking at how that might actually change moving forward. But there we go. We don't always get to have things as we expect them to be. But if you have joined this, I appreciate you. I'm just going to have a look at the comment section because I know that there were some people typing in some things here. Let's have a look and see what we've got here. Yeah, so this is an interesting one. Don't think the Bank of England is going to be the first to increase the rates. You know, the Feds came out yesterday and said, look, we're not. The Americans came back and said, look, we're keeping it. We're keeping it low at the moment. And when I read that this morning, I was kind of like, okay, I wonder whether they will move because they were going to be the first central bank to do that. How much of a cue they took from the Americans, I don't know. But interesting. But I would definitely agree with you on that one. Swit is saying here, I've literally just taken out a secured loan. So if I've done it on a 2-year fixed, hope that was the right thing to do. I mean, if you've already taken it out, I mean, if you hadn't and the bank rate had gone up today and you hadn't taken out that 2-year fix, you could argue that as a result of the bank rate increasing, you probably would have not got that 2-year fix at the rate that you got it already. Whether your broker or whoever it is that you've taken this 2-year fixed out with anticipated that there would have been an interest rate rise and priced that 2-year fixed rate accordingly is a question that maybe you need to ask them. But I think if you're locked in right now, it's not just about now, is it? It's about, what might happen in Q1 and Q2 next year. If the rates do increase in the first half of 2022 to 0.5%, then you could argue that potentially the mortgage rates or the rate that you would have got in 6 months' time might have been higher than what you've got today. I think the bigger thing here is think about, does it put you in a space where you feel more financially secure in terms of planning and knowing that you've got a 2-year fixed and you know that you're not going to have any nasty surprises? If that gives you, more peace of mind, then I think, you've probably done the right thing there. But it's hard for me to say because I'm not in your shoes. But yeah. Hello and welcome. Thank you so much for joining. I appreciate you. I have to say, I was in London yesterday and I bumped into 2 of you on the street. And I just want to say thank you. If you do see me walking around, it's always nice to meet the people who actually watch the channel. It really, really is. Because sometimes I'm in here all the time, creating videos and pushing out podcasts and speaking and doing all kinds of stuff. So I never really get to meet the people that I interact with, not physically anyway. I mean, you guys can see me right now, but I never get to see you. So it's nice to actually meet people who actually watch the channel and interact with the channel on a regular basis in person. I don't know. It's very, very weird. It almost puts like a face to the comments and the names that I see all of the time. So that was really, really good. Bumping into a number of you yesterday in London when I was taking meetings. And if you do see me out and about, do say hello, because the more of you I can meet and the more I can put faces to names and comments, that is very much welcomed. Let's have a look at this one. So it remained the same, but what was the vote? The vote was 7-2 on the MPC, so the Monetary Policy Committee. There are 9 of them, and obviously, in order for a vote to have to be in favour, you need a vote of 5. So it was 7-2 to keep the rates the same. Let me just find that one. Where are we? I think we've got a few more comments on here. Yeah, Noel is saying here, bad news for savers. It is bad news for savers. This is my big concern. My big concern is that if you are a saver and you are looking at the news today, so potentially inflation 5%, and you're looking at your bank account and you understand the relationship between inflation, savings rates, and what you need to do in order for your money to grow. My concern is that it will push more people to take investment risks without really understanding the risk that they're taking. That's my concern as a creative and someone who's worked in the financial services industry. And I wonder how many more people it will push to the markets because you can't get anything as a savings rate. It's one of my concerns. But there's nothing we can do about it. I mean, these are all things outside of our control. And I would say that, if you are a saver and what I've just described there is one of your concerns and how you're feeling right now, if you are thinking about investing in the market, please be prudent. And, I can't mention the markets without mentioning, crypto and Bitcoin. Again, more scams. We had Cyber Eats 2 weeks ago. I think the latest one a couple of days ago is Squid Games. That token gone. I think the number that they walked away with was 2.5 million. Please don't start looking at all of these investment opportunities that are promising, ridiculous returns and this idea that you can be rich overnight. Please be careful with those. And they will be extremely popular now, because they know that people will be desperate. People are anxious. People are really invested in this idea of making their money work harder. So please, 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 if you're going into any investment, you're going into anything at all, Forex trading or Forex services being offered, crypto especially, please make sure you're doing your due diligence. Please make sure you're doing your due diligence and just don't FOMO or YOLO into something and hope for the best. And you know what? I have to say this as well. The increasing narrative that I'm hearing is invest what you can afford to lose, right? Only put in what you can afford to lose. And then you have people putting in 500, 600, 700 quid, £1,000 into something. Even investing what you can afford to lose recklessly is still reckless, okay? You should still do due diligence. I mean, look, would you take £1,000 and give it to a guy on the street who says, look, just wait here, mate. Give me £1,000, wait here, don't move. I'm going to go around the corner. I'll come back with £2,000. Would you do that? You probably wouldn't. You'd at least want to follow the guy to know where he's actually going. You will ask him pertinent questions. The same thing applies here, guys. Please, please, please be careful. But it is bad news for savers. And my concern is that you will have more people, fall for all kinds of scams now because the pressure is on. The pressure is really, really on in order for you to make your money work harder for you. Someone's just saying here, I'm just about to buy my council flat on a 5-year fixed rate. Yeah, Ebby, look, if you're comfortable with the rate, I mean, I think if you're just buying a house to start off with, it's going to be about that financial planning piece, isn't it? You're looking at your personal finances and making sure affordability. And as you go through the mortgage application, affordability will be one of those key considerations, right? Can you actually afford to pay the mortgage? So you're trying to plan. If 5 years, having a 5-year fixed rate mortgage gives you comfort in knowing that actually, you know what, this mortgage payment, I can keep the roof over my head, no problems at all, then that's a good thing. That's a really, really good thing. As long as you're comfortable with it and it ties into your own personal financial plan, that's the most important thing. So Noel is saying it, I'd get a 10-year if I can, but 5 years is good. If you can get, so if you went for a 5-year, if you went for a 10-year fixed rate mortgage over a 2 or a 5, the only thing you need to be mindful of is what rate are you locking into? 10 years is a decade. So a lot can happen within a decade. Interest rates can move in a decade quite significantly. So if you're happy with a mega long period where right, my mortgage rate is going to be absolutely sweet and that's planned for, that's already put into your plan, that's completely fine. But at 10 years you are going to be paying a premium. The question is, will you be happy with that premium? I mean, are we ever going to get into a territory where interest rates will go back to the levels that they were in the 1970s? Probably not. I mean, the interest rates back then were absolutely crazy. You're looking at 15%. Think about what the mortgage payments would have been back then. But everything is relative, right? So will we get back to that kind of territory? Probably not. But over a 10-year period, if you're looking at a 10-year fix, for example, what is the likelihood that you might see rates at around about 2 or 3%? I don't know. Those are the kind of things that need to be considered. But definitely on 10-year, you'll be paying a premium over the 2 and the 5-year. But it fits into your plan. There you go. Yeah, so give up saving, it's a mug's game. I mean, the only alternative to that would be investing. But obviously, investing, capital at risk, making sure that you know what you're going into, you're doing your due diligence, you're making sure that you are managing your downside risk. Because investing, oftentimes it's all about what you can make, not about managing the downside and limiting what you could potentially lose as well. So that's a really important point just to stress with that as well. Ebby, you're just saying there you just signed off the mortgage and I'm worried now. I mean, if you went to a mortgage broker, maybe just have a conversation with your mortgage broker. That's what I would say. Yeah, someone saying invest where? I mean, look, no, there are different places you can actually invest and different approaches to it. Probably not one for this live, but there's lots of content on the channel which basically talks about, how you can invest. You've got ETFs, index funds, all kinds of things. There's plenty of stuff that you can actually do. Neil's saying here that the pound is actually tanking as well. The last time I checked, the pound was down, I think, against the euro about 1% because they were anticipating that the bank rate would increase today. So it's interesting. There we go. There was a comment in here. Let me just see if I can find this. This looked really interesting. I think, is that a crypto? Okay, I'm not going to bring that up because I'm not sure what that is. All right, there are a couple of crypto questions in here. I will do a live. Our next live is on Sunday, so I can take some questions around investing and cryptocurrency and all that kind of stuff on Sunday. But guys, I appreciate you for watching this Thursday afternoon. Not the news that we expected, but it is what it is. We will adapt either way. I hope you enjoyed it. If you are watching this on a replay, thank you so much for watching. Make sure that you subscribe if you aren't subscribed already, or if you want to. And what would really help me out is if you smash the like button for this video so it actually ranks a little bit better for the YouTube channel, for the YouTube algorithm, I should say, and it will help other people who are interested in knowing what happened today also see the video. So I appreciate every single one of you who is here and who has watched. Don't forget, if you do want free shares with free trade, I'll post some links and stuff like that. So if you're looking to invest, you want a free share up to 200 quid, you can get that with free trade. There's also free shares with stake, and so on and so forth. So yeah, guys, I appreciate you. Have a good afternoon.